Hello again. So it's session 2 for the day, and in the first session we had a discussion with respect to what we call balance sheet item. It was a comprehensive one, and I'm very sure that now you are feeling absolutely confident as far as items of balance sheet is concerned. So by that time now, actually, you should be well proficient enough to actually acquire mastery to and have the confidence to segregate each and every item into proper categories, presuming that each one of you now are well aware of all such things. So we can now proceed to start buyback of shares. What we mean by buyback of share, first of all, we need to understand that correct buyback of share is almost similar to redemption of preference share. Whenever a company issues preference share, company commits itself that these shares will be redeemable within a maximum period of 20 years and in some special cases within a maximum period of 30 years, correct? If you are going to buy the preference share of a particular entity, in that particular case, entity will give you in writing that your amount will be redeemed, correct? A specific date will not be given, but company will definitely give you a deadline that within 20 years or in some special cases, as I said, within a maximum period of 30 years. Howsoever, there is a certainty, there is an assurity that your amount will be redeemed by the entity. So in case of preference share, company redeems the amount, returns the amount, it means. Similarly, when an entity floats debentures, so debenture holders are given specific dates and the time and the duration that after which year, after which date your amount will be redeemed. Suppose if you are going to buy the debenture of a particular entity today, then company will give you in writing that after these many years your amount will be returned. So in case of preference shares and in case of debentures, there is a definite commitment on the part of the entity that amount will be redeemed. However, when an entity issues equity share, there is never ever a definite commitment that after what period your amount will be redeemed. Are you getting my point or not? Unlike redemption of preference share and unlike redemption of debenture, in case of equity share, company never commits itself that your amount will be returned. Howsoever, company has the right, especially nowadays, entities have the right that they can repurchase your shares from the market. So after issuing the shares, company can ask the shareholders that we means the entity is interested in repurchasing the share. So that is also a sort of mode, or it is also a sort of, you can say, redemption of shares. However, we never use the word redemption of equity share. The reason is that in case of equity share, entity never commits itself in the initial stage that it is going to return the money. So rather than saying redemption of equity share, we are going to use buyback of share. That's a different part. That buyback of shares is almost similar to redemption of preference share or equity share, correct? So we will not use the word redemption of equity share. Rather, we are going to use the word buyback of share. However, the meaning almost is same, correct? Internal meaning is same. In all the cases, company will return the amount of the shareholders. So we have to learn now the intricacies of buyback of share. So first of all, let me actually write here what we mean by buyback of shares. So buyback of shares simply means buyback of share. Simply means buyback of share. Simply means repurchase of own shares, repurchase of own shares from the open market, So company can simply make an offer to the shareholders that we are interested in repurchasing our shares. So if you are, means the shareholders, if you are interested in selling your shares back to the entity, we will repay the amount to you. So that is also a mean of redeeming the equity share. Time and again I am telling, we will avoid the word redemption because there is no definite commitment earlier. Is it clear to you or not? We will talk about buyback of share. We will also talk about why we go for buyback of share, under what circumstances an entity goes for buyback, what sort of mileages or advantages buyback of share will bring to the entity. All these we will cover later on in the theoretical part, but at this moment our focus area is accounting area, and later on we will talk about what we call that why buyback of share is generally resorted to by the entities, what advantages it could deliver to the entities, and why, what are the compulsions or what are the advantages which forces an entity to go for the bonus issue. But these points we will talk about, as I told you, later on when we'll pick up the theoretical aspect. At this moment, in this particular session, we will try to learn the art and craft of accounting for buyback of share. Correct? So when a company goes for buyback of share, what exactly is the accounting methodology? What exactly the accounting techniques are? So we will try to what we call grasp them. So I have written simply means repurchase of own shares from the open market. Now we will try to understand the concept of buyback, understanding the concept. So in order to understand the concept, I am going to pick up one example, and through that we will try to understand the concept. Correct? So in order to understand the concept, I am writing one example down over here, and then we will try to understand it. Example. Now, example is that there is balance sheet extract which is given to you. This is balance sheet extract. Balance sheet extract. Balance sheet extract. Extract means piece of information. This is balance sheet extract of, say, T1 Limited. This is the name of the company, T1 Limited. Correct? This is balance sheet extract. Some information is given to you. One, information given to you is shareholders fund. Shareholders fund. In the shareholders fund, information given is A, share capital. Share capital, say 50,000 shares. I will write here 50,000 shares of rupees 100 each. Of rupees 100 each. So total share capital of the company is 50 lakhs. We presume that it is equity share capital, correct? And then some information is given with respect to reserves and surplus. So reserves and surplus given to you are general reserve. Let us say general reserve balance is 5 lakhs. General reserve balance is 5 lakh, and profit and loss account balance is just about 7,50,000. So this is the piece of information which is given to you. Is it clear to you? Now, this is the question, and question is that on this date, directors decide. On this date, directors decide to buy back 25% of its equity share capital. 25% of its equity share capital at par. Correct? So this is a very small version a very small example which has been delivered to you, and through this we will try to understand the intricacies of accounting as far as buyback is concerned. Now you know the meaning of buyback. Buyback, in simple words, in a layman's language, means redemption of equity share capital, but we will avoid the word redemption. We will use instead buyback of shares, correct? So when a company will buy back its shares, the entry is very simple. Even if I will not tell you, you know the entry, I know this, correct? For example, when a company will issue the shares, company will make the entry cash account or bank account debit to share capital account. Correct? When a company will issue the shares, company will receive cash and share capital of the company will increase because company will offer shares to the public. This is the entry for issuance of share capital. And when a company will redeem the equity shares, then company will ask the shareholders to give back their shares. So shares will come back to the company. So share capital will be debited and company will now pay them cash. So this is the entry for redemption of equity share capital, or in other words, this is the entry for buyback of equity share capital. Isn't it or not? This is the entry generally you use for redemption of debenture, for redemption of preference share capital also. So capital will come back to us, shares will come back to us, and we will offer them cash. It is very simple entry, but it is not as easy. So we must understand the logics and the accounting aspects through this particular example. Before we move over to the example, I would love you to classify, because you have just learned the art of classifying the items. Could you tell me the nature of general reserve? Yes, sir. It is revenue nature reserve. Very good. So you have become absolutely expert. It is revenue nature reserve. Even profit and loss account is revenue nature reserve. Correct? I would love you to learn this particular art, as you will see later on that it will hold you in a very, very good state and you will have a good control as far as accounting aspect is concerned. Now we will try to solve this question and we will try to understand the accounting methodologies. Suppose if I would toss a question to you, how many number of shares are there as per this particular example? Sir, total number of shares are 50,000. Good. Total number of shares 50,000. Sir, why you are asking this question? It is written over here. Yes, even I know that it is written over here, but still I would love you to give me the answer which you have already given me. Total number of shares. Total number of equity shares. We are presuming that share capital is equity shares. So total number of equity shares 50,000. Now could you tell me the number of shares which company wants to buy back? So of course it is written again in the question, 25% of the equity share capital is being bought back. So company is buying back only 25%. We will talk about later on when we will pick up the theoretical part that maximum number of share which an entity can buy back cannot exceed 25%, but it can be lower than that. Correct? Anyway, at this moment, your focus area should be over here only. We are not entering into the legal jargon at this moment. So total number of equity share is 50,000. Buyback is 25%. So you will simply write buyback. So buyback, how many shares company is buying back? So buyback is of 25%. So you shall write here 25% of 50,000. That happens to be 12,500. So in this case, company is going to buy back 12,500 shares. Correct? So I would love you to make a note of that. Correct? Even though it is very specifically mentioned in the question, but the best way is to not to commit any mistake. Correct? So that is the reason you have noted it down. Now we will move over to the journal entries. As far as accounting aspects are concerned, we have to pass journal entries. So journal entries in the books of this entity T1 Limited. Now as far as journal entries are concerned, what will be my first entry? first entry will be, let me write the definition first, amount due for buyback. Amount due for buyback. Yeah, amount due to shareholders. You can simply write this way. Amount due to shareholders. This is the entry you are supposed to mention down over here. Correct? That means your first entry should not be share capital account debit to bank account. Of course, that is the net entry, no doubt about that. So you are repaying the shareholders, you will receive your shares back, you are doing the accounting from the perspective of the entity. Correct? You presume yourself to be the accountant of the entity. So from the viewpoint of the entity, you will have to pass the entries. So you will receive your shares back and you will pay them cash, but you will not immediately pay them cash. Correct? So that is the reason my first entry will be equity share capital account debit. Equity share capital account debit. How many shares you are buying back? You are buying back 12,500 shares at par. That means at the rate of 100. So 12,50,000 worth of equity share capital will float back to you. So this is the entry which you will have to pass. Is it clear to you? Then you will write here to equity share buyback account. Equity share buyback account. Equity share buyback account. Now equity share buyback account is nothing but it is equity shareholders account. Short form I will write henceforth ESBB. Equity share buyback account. So that means you are supposed to pay 12,50,000 to the equity shareholder. But you cannot make immediate payment. Correct? Very simple, very innocuous question, very innocent question. But in spite of that, as I told you, we have to understand some intricacies. When an entity buys back its share, there is a little bit of problem also. Now, what exactly that problem is, so we will try to understand that problem. See here, when a company buys back its share, actually a major problem also arises. Now, what exactly that problem is? Before I dwell means before I discuss that particular problem, you must know the meaning of capital base. I will use this term a lot of time now. Capital base. Sir, we are hearing this term first time. Even I know. Capital base. First of all, let me make it absolutely clear. Please don't confuse this term with capital employed or capital structure. Capital structure or capital employed, the terms which you are more familiar with in accounts and in costing, are entirely different from capital base. I have written here capital base. I am trying to tell you the meaning that when a company buys back its share, there is a problem associated with it. Now, what sort of problem is that? Now, pay attention. We generally use a term capital base, and capital base has got three components only. Capital base, it is different from capital structure and it is different from capital employed. Capital base comprises of three components: equity share capital, preference share capital, and capital redemption reserve. Capital redemption reserve. Capital base has got only three components. Please try to understand the meaning. Correct? Now, suppose if I give you this balance sheet, this is the original balance sheet which is given to you. This is demonstration problem. Now, if I would ask you, as per this balance sheet, could you tell me what is the capital base of T1 Limited? Obviously, you will give me the answer within a flick of second, isn't it or not? Within a flick of second, you will tell me, Sir, as per this balance sheet, equity share capital is 50 lakhs. Equity share capital is 50 lakhs. Correct? And there is no preference share capital. There is no capital redemption reserve. So, capital base of the company as per this balance sheet is 50 lakh. Is it clear to you? Now come over to this particular discussion. When an entity buys back its own shares, the problem is that capital base of the company gets altered. That is a big problem. That is not a small problem. That is dangerous situation. That is a horrendous one. The capital base of the company gets altered. What I want to say here, just pay attention. When you have written this entry, or when you will write that entry, that is due entry, what happens? The capital base will get changed. Capital base will get altered. What I want to say here, see here. In the entry, equity share capital is debited. It means when you are going to pass this entry, your equity share capital will now get reduced to 37,50,000. When you will pass the first entry, after the first entry, equity share capital has come down to 37,50,000. There is no preference share capital, there is no CRR. So it means now my capital base has been reduced to 37,50,000. That is the major problem. So when an entity actually buys back its own share, the bigger problem is that actually capital base of the company gets altered and no company can afford any changes in its capital base. That is the main point. Are you getting my point or not? So basic problem associated with buyback of shares is that when an entity will go for buyback, company will have to pass this entry. This is the due entry. The moment company is going to pass this entry, the capital base of the company will get altered. And the moment capital base will get altered, then it becomes a headache for the company. Why? Because an altered capital base cannot be afforded by any entity. Is it clear to you or not? No entity worth its salt can afford any changes in its capital base because it brings about horrendous consequences. No financial institution would love to actually extend any credit facility to us. Similarly, the potential investor will shy themselves off from investing their hard-earned money into the concern. And similarly, suppliers of raw materials are going to show a lot of hitch and hish in extending any credit facility to the said concern. So this is the bigger problem. Are you getting my point or not? So when a company goes for buyback, the capital base of the company gets altered and no company can afford any changes in its capital base. That is the major problem. So what is the theme of buyback? What we are supposed to do? Try to understand. So the bigger problem in buyback is that company naturally will have to refund the money of the shareholder. That means company will have to make the payment. But the problem is that when we will go for the buyback, the capital base will get altered. So the basic problem revolves around the fact that under buyback, we have to make the payment, but at the same time, we have to see to it that our capital base remains unaltered. We have to see to it that our capital base remains unaltered. Even though if it has altered, we have to see to it that it is restated to its original level. What I want to say is that. So now, when we have passed this entry, our capital base has altered. And now we know, after a little bit of discussion, that no entity in the world can actually afford any changes in its capital structure, as it is going to bring about horrendous consequences, as I said. So it becomes imperative, it becomes necessary for us to restore our altered capital base to the original level. We have to restore our altered capital base to the original level. Now, how we have to restate, how we have to restore the capital base. So, next entry, actually deals with it. Now we have to restore it to its original level. So how will we achieve that? In order to achieve that, we will have to pass an entry. First, let me write the entry, then I will explain the concept. Utilization of, see here what I am writing, utilization of revenue reserve. That is the reason I wanted you to have a solid knowledge regarding the balance sheet component. So now you know the meaning of revenue reserves. So utilization of revenue reserves for restatement of capital base. For restatement of capital base. Restatement of capital base. So you have to now restate your capital base. In order to restate your capital base, what you are supposed to do? Very simple. First of all, whenever an entity will pass the entry for amount due to shareholders, the capital base of the company will get altered. So it becomes necessary, it becomes imperative to restore it to original level. In order to restore the capital base, company will utilize its revenue reserves. Try to understand. So that is the reason you should be skillful enough to select your revenue reserve. Now in this balance sheet, we have general reserve and profit and loss account as the two items which are of revenue nature. So I will pass a bookish entry. What we mean by bookish entry? Bookish entry means an entry which affects either only liability side or what we call asset side. The entry which affects either liability side or asset side only is called bookish entry. So in order to restore our capital base, we have to utilize our revenue reserves, and entry will be general reserve account debit. I will pass a bookish entry. General reserve account debit. General reserve account debit 5 lakh. Then I will write profit and loss account debit. Profit and loss account debit 7,50,000 to capital redemption reserve account. To capital redemption reserve account. To capital redemption reserve account, that is 12,50,000. 12,50,000. We have to pass this entry, utilization of reserve. What is the use of this particular entry? Now try to understand. You are making a buyback of 12,50,000. When you are making a buyback of 12,50,000, your capital base is getting altered by 12,50,000. So you have to restore it to the original level. In order to restore it original level, we are going to utilize our revenue reserves. When I will pass this entry, what will happen? Our general reserve balance and profit and loss account balance will get eradicated from the balance sheet, isn't it or not? Because these are credit balance and now I have debited it. So these balances will appear no more in the new balance sheet. However, a new item will appear in the balance sheet by the name of CRR. Is it clear to you or not? Is it clear to you? So a new item will appear in the balance sheet by the name of CRR. So now you can see, after having passed down your second entry, the position is that your equity share capital is 37,50,000. There is no preference share capital, but now there is capital redemption reserve to the extent of 12,50,000. So now you can see that your capital base has been restored. Is it clear to you or not? Your capital base has been restored. Is it clear to you or not? So this is just for the understanding. So things should be clear to you now that when a company will go for the buyback, the capital base of the company gets altered. So capital base must be brought up to its original level. We call it in accounting language as the restatement of capital base, and often it is called as restorement of capital base. In order to restore the capital base, company will utilize its revenue reserves. Only revenue reserves. No other reserve can be utilized. No capital reserve can be utilized, and no question of utilization of a specific reserve and what we call a statutory reserve. Only revenue nature reserves can be utilized for the restorement of capital base. Is it clear to you? So basic problem is that, now please pay attention. Here I am writing restorement of capital base, restorement of capital base, restorement of capital base, restorement of capital base. So restorement of capital base. Is it clear to you? So restorement of capital base. In order to restore your capital base, what you need to do, you need to note down the nominal value of equity share capital to be bought back. Nominal value of equity share capital to be bought back. Nominal value of equity share capital to be bought back. So you have to note it down carefully, which you have noted down already. Bought back. That is 12,50,000. This is 12,50,000. This is the nominal value. So when you will buy back 12,50,000 worth of equity share capital, what will happen? Your capital base will fall down by 12,50,000. So you have to restore it. In order to restore it, what you did? You utilized utilization of reserves. In order to restore it, you utilized your revenue reserves. Utilization of reserves. Is it clear to you? Utilization of revenue reserves. So you utilize general reserve to the extent of 5 lakh. And you utilize profit and loss account to the extent of 7,50,000. So that is how you have been able to replace 12,50,000. Isn't it or not? So 12,50,000 have been replaced by what we call 12,50,000 in the form of CRR, because when you utilize the reserve, actually you transferred it to capital redemption reserve. Remember one thing, this entry is not affecting cash. This entry is not affecting, to be honest with you, anything. The reason is that when you will pass this entry, what is happening? Now general reserve is getting cancelled, profit and loss account is getting cancelled, and it is being replaced by CRR 12,50,000. Is it clear to you? So now in the balance sheet, instead of general reserve and profit and loss account, 12,50,000 will appear. So that is the reason now we can say that in the new balance sheet, our equity share capital will be 37.50, CRR will be 12.50, and thus our capital base will be 50, which was also in the initial stage, that is as per the original balance sheet. Is it clear to you? So the major problem of buyback is that an entity has to make the payment to the equity shareholders, but at the same time company will have to see to it that its capital base remains at its original level. So after you have made sure of the fact that your capital base has been restated, now you will make the third entry, and third entry is for actual payment. Now you will pass the third entry, and this third entry will deal with actual payment. So now you will make the actual payment. Is it clear to you? So now you are going to make the actual payment. So entry for actual payment will be equity share buyback account, because this was the due amount. Equity share buyback account means equity shareholder account. Now you are going to make them the actual payment, 12,50,000 to bank. 12,50,000. So, in this particular session, we are trying to understand the accounting aspects. And as far as accounting aspects are concerned, we have seen that major problem with respect to buyback is that company will have to make the actual payment, but at the same time, company will have to see to it that its capital base does not get altered, or even if it has got altered, it must get restated to its original level. Is it clear to you? Now, some of you might be wondering, sir, in this case, we have got enough reserves, correct? There could be a possibility that you may not have sufficient reserve. For example, general reserve 5 lakh and 7 lakh 50 are sufficient. That is equal to 12 lakh 50,000, which is also the amount of equity share capital to be bought back. So we did not actually confront any problem. So in the next session, we will also see when reserves are insufficient. So in this concept, what we have analyzed that when reserves are sufficient, correct? We have taken a case of buyback when reserves are sufficient. Now, in the next session, we will see what happens when reserves are insufficient, what accounting methodologies will be adopted. So we shall talk about that, but in the next session. So till then, it's goodbye from here and good night also.